Hello, this is Jeremy Wagner of Daily FX Education, and I want to talk to you about range trading and how I range trade. So I've got a couple of situations that are up here on the chart, and they come from different backgrounds. So the first situation is when you have a strong trend, and then eventually, after prices move swiftly in a strong trend and have a lot of momentum behind them, they've got to consolidate all those gains. And so as they consolidate those gains, that's an opportunity for ranges to develop. And so I'll go out and I'll take a look at a daily chart, and I'll use these two different settings of Bollinger Bands. It just kind of depends on what mood I'm in. I'll use a 20 and 2 setting or a 50 and 2 setting. And so essentially what the Bollinger Bands are going to look like on this is they're going to start off on this strong downward trending move. Bollinger Bands are going to start off and they're going to widen out as the volatility picks up. And then eventually these bands will begin to trade sideways. And so it's in this sideways movement is what I'm going to be looking for as a trader. You see my bands are horizontal. They're also parallel to each other. I've got really no net gain or net movement in the price. And I also have no net gain or net movement in the Bollinger Bands as well. And this is more likely to occur when you use the 50 and 2 setting. So if you take a currency pair like the Swiss yen, that's a currency pair that eventually, sometimes it may get into some strong trends, but a lot of the times it's just going to oscillate back and forth. And so on a Swiss yen, I'll definitely use a 50 and 2 setting and widen it out, because those could be good levels of support and resistance. And so how I trade this, and by the way, in both of these range trading scenarios, I'm going to be very picky with my range trade setups, meaning I want to be looking for that ideal tight stop or that ideal situation where it's hitting that extreme of the range. So in this situation, I got a downtrend, prices are consolidating, so I'm going to be very picky about waiting for the price to come up and actually reach my upper band. You see, with the direction of the previous trend being to the downside, prices were in a trend, they're going to consolidate, and then a lot of times, not always, but a lot of times they'll resolve out of this range, they'll break out of this range to the downside. So that means I'm going to be looking at the top side of the range as an area to sell short into, and I'm going to be very insistent and picky about waiting for these prices to make it up here. Because a lot of volatile or trending movements, you just never know. If you enter in this area, and then sometimes you'll get the bounce up, and you don't quite have that good risk-to-reward ratio. Whereas if I am very picky, and I'm going to miss a lot of trades doing this because I do want to be picky, I want to make sure I have this good tight stop risk-to-reward ratio. And as far as a stop, I'll just put an area above the band. So that's the first situation. Looking at a daily chart, looking at Bollinger Bands, at least a 1 to 2 risk-to-reward ratio, being very picky on my entry. Now, the second type of range situation is one where maybe I've run into a string of losses on my trading, and maybe I'm a little down on my luck, and kind of beat myself up because I've had a couple of losing trades, and I think you know what I'm talking about as far as entering into those types of emotions and situations. When that happens, a lot of times what I'll do is I'll go out and I'll take a look at the Aussie Kiwi. And the Aussie Kiwi, the Aussie New Zealand dollar, can be kind of a boring or a very unexciting currency pair. And as a matter of fact, if you pull it up on like a 4-hour chart, or even do like a 1-hour chart, you're going to see candles that look like this. I mean, it looks like a bunch of dojis just lined up on top of each other, and it doesn't look like they're really going anywhere. And so you immediately move on to the next currency pair because you're thinking, well, why would I want to trade that? Prices aren't going anywhere. But that's exactly what I'm looking for, especially after I've had a string of losses and I want to kind of get those moral victories and getting back in the right swing of things. I'll come out, I'll check out the Aussie Kiwi, and you'll notice if you take a close look at the chart, prices are going to oscillate and bounce up and down in between strong support and resistance levels. And so I'm simply going to come out, I'm going to look for these support and resistance levels and play that range. And it won't come across as, knocking off 100 pips overnight. You go to bed that night, you wake up the next morning, you got 100 pips in your pocket. It's not going to be that type of trade. But again, if I'm very picky about where I'm picking my entry to go long or my entry to go short, I can catch a fairly tight stop, and then it may take it a couple of days, but eventually it'll make its way there, and I'll have my 1 to 2 risk-reward ratio, and I really haven't risked a whole lot because of the pip cost on this currency pair. The pip cost is much less, so dollar-wise you're not going to make a ton of money, but it's more of that moral victory of walking away with that win, especially after I've had a string of losses. And then also, because it is trading the Aussie and the Kiwi, two economies that are very similar to each other, then the price generally isn't going to run away from you unless you have like an Australian central bank rate announcement or New Zealand, unless there's some type of news event. Usually this pair is not going to run away from you. And so that's why I like looking at it in ranges, and especially if I've run through a string of bad luck or I'm getting down on my luck. I'll use this as a way of catching up some moral victories. So that's how I use range trading, and I want to wish you the best of luck in your trading as well. Thanks for listening.